Welcome to the BizBen podcast, the show that explores all topics relating to selling and buying small to mid-sized California businesses. And now let's join nationally known consultant and author, the host of this podcast, Peter Siegel.
Hi, this is Peter Siegel. Welcome to our online discussion on business purchase financing. First, I want to thank all of the viewers and listeners who submitted both questions and topics for this program. This discussion is designed for business buyers, seller owners, business brokers, agents, and small business advisors who are interested in utilizing financing to leverage their purchase or utilizing the financing for the down payment. In today's video and podcast, I'm going to chat about SBA loans, non-SBA loan financing, and alternative types of financing to buy small to mid-sized businesses. But first, a little bit about me. I've been advising borrowers on business purchase financing for over 25 years. I'm the founder and principal of both BizBen.com and BizBuyFinancing.com. In my past, I was a specialty business broker and a 4-time small business owner where I sold 2 my own businesses, had a business broker sell 1, and have purchased several small businesses to accompany the businesses I had owned in the past. So I've seen it all, I believe, from all perspectives when buying or selling a small business. These days, I assist business buyers, business owners, sellers, brokers, and agents with pre-qualification and then secure the right type of business purchase financing with one of the 200 different financial institutions I work with throughout the U.S. I want to share with you today some very important information about business purchase financing and how it works, since there's a lot of bad information out in the marketplace on this topic at this point in time. So first, let's chat about SBA loan financing when buying a small business. First, some general information about SBA loan financing. Most people have heard that SBA loans take between 3 and 6 months from start to finish. It usually takes that long if the broker or the agent, the landlord, or the attorney takes time to get back critical documents or information back to the lender or escrow. Typically, when I work with SBA lenders, I find if they have the capacity or bandwidth to actually do the loan at that time, and it typically takes 30 to 40 days instead of the 3 to 6 months. So you have to be very careful about the lender and the contact that you actually select for SBA financing. Most lenders also like to do SBA loans over $150,000. They won't tell you this, but they like doing the larger loans. Again, over $150,000 for business purchases. For most lenders, doing an SBA loan for business acquisition financing under $100,000 is just not worth their time. There are other financing tools for accommodating those size loans for business purchases. It's important that the business is properly valued, meaning that it's not overvalued, since all SBA loans must be vetted by a third-party business valuation firm before the close of escrow. If the business is overpriced, the loan will not get funded. Accommodations will have to be made, lowering the price, etc. In my practice, I always look at the price and deal structure first to make sure it's going to pass the appraisal process. You don't want any surprises like an overpriced business to derail your deal. Loan terms. Loan terms are typically 10 to 25 years in length, depending if there's real estate along with the business in the transaction. It depends on what the value of the business is to the real estate. For example, if there is a large value placed on the real estate portion, then it'll be stretched out to closer to 25 years. Being accurate and writing clearly and legibly is super important. When an underwriter at a lender or financial institution picks up your application and package, and if it's unorganized and unlegible, they will start forming an opinion of you as a borrower at the very beginning. Make sure it's neat and tidy. I can't tell you how important that is. I hear from underwriters and managers at SBA lenders all the time, and they tell me 70 to 80% of the time those packages are just not put together real well, and that's what can hold up your deal. If you're using an SBA loan for financing, you need to go through the escrow process, and usually it's the escrow and bulk sale process to coordinate with the SBA loan. This is very important since you'll want to work with an escrow company that understands the SBA loan process and can work with financial institutions coordinating the loan. Going to the right contact and the right financial institution is the most important, and I'm going to repeat this throughout this entire chat. That's how important this is. There are a lot of banks out there that do SBA loans, or basically certified by the SBA to do SBA loan financing, but they're all different. They all have different specialties, they all like different types and sizes of businesses, and they all have their nuances. Then the salespeople who work for these SBA lenders don't necessarily tell you these things hoping that a deal typically will try and get through. So you really need to know which lending institutions, what types of businesses for sale, what size businesses for sale, and what geographic locations. That's super important. Okay, now let's talk from the buyer's side. What are the important factors for SBA loan financing? First of all, let's talk credit score. Credit scores typically need to be above 650 or above. So you want to run your credit score and see if it's at least that or higher. The higher, the better. Work experience right now is very important to lenders, and how your work experience relates to the business that you're going to be buying. If you're a software engineer and you're trying to buy a restaurant, you're probably not going to get SBA financing. The next is savings and personal liquidity. Lenders look at how much you have in savings, and they don't want you using all of your savings for a down payment. They usually want you to have 10 or 20% in reserve just in case you fall back on hard times when you actually run the business. So you want to make sure that you don't use all or plan on using all of your savings for the down payment, because if you show that to the lender, they typically will ask you not to do that, which means that you'd have to buy a smaller business. If you own a business now, is it profitable? Do revenue and cash flow trends, are they going up? Are they even? The SBA lenders want to make sure that if you own a business, that you know how to run businesses and how to run businesses profitable. They're not real amenable to lending money to someone who owns a business and it's not making money. So if you own a business, hopefully it's profitable and the revenue trend is even or going up. Do you own any real estate, either personal residence or investment property? Because if you do, the lender is going to take collateral off of that real estate, and they typically want 20 to 60% coverage. Now this is where SBA lenders are different as well. There are some SBA lenders out there that want full collateralization on their loans. Typically the lenders I work with want some type of collateral coverage, 20 to 40%. But some lenders, if the deal's strong enough and it has a lot of these data points that we're talking about today, sometimes you don't need any collateral as long as the work experience is there, the cash flow from the business is strong, and those types of factors. So although collateral is important and makes a deal stronger, it's not necessarily needed. The lender's also going to look at your credit card balances. How many cards do you have? What are the balances on the cards? If you have a lot of credit cards and you have large balances on your credit cards, you're typically not going to get an SBA loan because they want to see how much personal debt you have as well. So if you have a lot of credit cards, they may want you to pay those down or pay those off before they actually give you an SBA loan. So that's one thing to look at, and that's one thing I look at with my clients as well. Down payment. A down payment on an SBA loan, depending if it has real estate or not, is typically 10 to 25%. You can't borrow those funds. Sometimes I have clients who call me and ask me, well, I can get, X amount of financing or for the down payment because I can borrow money from my folks. You can't borrow the down fund. That is a rule by the SBA, so you can't borrow funds for the down payment. And again, the down payment needs to be 10 to 25%. So if you don't have the 25% down, let's say you can put down 15%, if the owner's willing to carry a note for, let's say, 10% to make up that difference between 15 and 25%, then that's doable. But again, lenders look at everything. It's not black and white with lenders. They typically look at all of these factors to see if they feel comfortable with those particular deal points. The other thing that lenders look at is if you have any bad debt, student loans, home foreclosures, bankruptcies. Any of those factors typically will put your chances of getting an SBA loan in seriously a lot of doubt. So you want to actually look and see what your total package looks like. Everything from your credit score to work experience, your personal liquidity. If you own a business, is it profitable? And if you own any real estate, how much equity do you have in real estate? Credit card balances, how much do you have for a down payment? Is it seasoned, meaning has it been in a bank account for some length of time? They're looking for that too. They don't want to see a down payment that has just mysteriously shown up in a bank account, and because they know typically that that's probably you've gotten the money from someone and you may have borrowed those funds. So it's got to be seasoned in a bank account, usually for 3 or 4 months. Let's talk from what's needed from the seller side for SBA financing. So probably one of the most important things for SBA financing from the seller side is cash flow, or SDE, which is seller's discretionary income, SDI, adjusted net income, etc. And you want to make sure that that cash flow will support the debt service and your annual living expenses. That's what the underwriters are actually looking for. Now, cash flow, seller's discretionary cash, adjusted net income is basically owner's salary plus interest plus depreciation, any one-time business expenses, all those add backs that can be added back for the new buyer. These are really important factors for SBA financing, and everybody looks at cash flow or adjusted net income differently. The way business brokers look at this to get their the value of the business is much different than, let's say, what a lender looks at adjusted net income. So when I actually advise my clients, I look at it more from a lender's perspective rather than a broker's perspective, because that's the way they're going to be evaluating the deal. Also, too, is real estate part of the deal. So are you selling a business with real estate? If real estate is involved, it's typically more attractive to lenders. So if you are a seller or if you're a buyer looking at deals, if you can find deals with real estate, it's typically more beneficial to do so. revenue and cash flow trends or adjusted net income trends for the last 3 years. Lending institutions want to know if it's up, if it's even, or if it's going down. Now, if it's going down, that's not a good situation, especially if it's 15% going down year over year. However, let's say 2 years it went down, but this last year it's going back up. That's okay. They just want a trend where it's going up and not going down. And you as a buyer probably don't want it going down as well when you do your due diligence. So again, cash flow and revenue trends need to be even or going up. Now, some lenders want a business plan. Now, this is a small business plan. This isn't a business plan typically required by a venture capitalist. It's typically 8 pages or less. It talks about where the business is at now, where the business has been in the past, and what you're going to be doing with the business to make it better. The lenders want you to demonstrate your knowledge of the industry and business that you're looking at buying. And that's the reason for these business plans. Only about 30% of my lenders who do small business administration loans require a business plan. And if they do, again, they're not real comprehensive, about 8 pages with some financials thrown in, and typically financials for the next 5 years. They want to see some kind of a demonstrated growth within those 5 years. Also want to see if there is management running the business. Is there a full-time manager that will stay with the business after you actually start running the business? So any type of management is good, whether it be part-time or full-time. And especially absentee is good, because they figure if it can run absentee then with someone who's actually full-time and running the business, it will probably do much better. So the lenders will typically want to know who the employees are, how many full-time, how many part-time, etc. They'll also look at the lease, and the lease on an SBA loan needs to be at least 10 years or more. And it can be any form of a 10-year lease, meaning it can be a 5-year with a 5-year option, or a 1-year with 9 1-year options. I'm working on a deal right now where the deal's going through and it has a 1-year term with 9 1-year options because the buyer is thinking of moving the business. So as long as it has some 10-year variable. It's really important too, if you're a seller, to talk with the landlord early if you're thinking about selling and you think that financing may be involved. You want to make sure the landlord will renew the lease or work with a potential new buyer on the deal. Very, very important. I've seen a lot of deals tank because the seller did not tell the landlord he was thinking of selling, and the landlord held up the deal, or he wanted somebody new in the spot, whatever. So make sure if you're a seller, and even if you're a buyer, that that particular seller has talked to the landlord and they understand that a potential new buyer may be coming in. Deal structure. We talked a little bit about that from the buy side. From the sell side, sometimes the owner needs to carry back a note. Now, if they carry back a note to help the deal out, let's say 10%, that means you're going to be getting 90% up front, partially from the down of this buyer, and then the rest coming from the financial institution. If you carry a note to help finance the deal, there's something called a standby provision. And in that standby provision, meaning that you don't get paid for 24 months, it's a rule by the SBA, it's called standby. But as I advise my clients, it's typically better to get 90% up front than not getting any financing at all up front, or not even selling your business. So that's a little bit about SBA loans, for both from the buy side and the sell side. There's about 24 different factors, both from the buy side and the sell side, that need to be looked at. Again, all lenders that provide SBA financing for business acquisition financing are different, and the way they structure their departments are different, the way they look at deals are different, the way they underwrite are different, and they can take a while, especially if they have a lot of packages in and your package goes to the bottom. So these are all questions that you're going to want to ask an SBA lender when you typically go for financing. Let's talk about some other financial tools to buy businesses other than SBA financing. Let's talk about retirement rollovers. And retirement rollovers is when you actually take a retirement vehicle like a 401k or an IRA and convert that to actually get the funds to buy a business. About 30% of my clients actually use this strategy either for a down payment or a straight business or franchise purchase. But you've got to be really careful when you utilize this type of strategy. There are firms out there that can help you with this, but I've noticed there's 2 or 3 firms nationally that typically do a good job, particularly when it comes to coordinating it with SBA financing. So when you go to look at converting your retirement fund, and usually that's tax and penalty free if you do it correctly, it could be a way of going of getting that down payment for the 10 to 25% down required by SBA financing. Now this particular process takes 3 to 4 weeks, which coordinates really well with an SBA loan. So if you're thinking about getting SBA financing, this can work really well with that. But again, going with the right company is critical. Just like with SBA financing, they have a certain number of underwriters and helpers that actually get these deals through. And if they're busy, it can back up a deal. And what this means is if a particular deal is popular or that's on the market and it's popular, you could lose the deal. So you want to make sure that that particular financial institution has the bandwidth to look at your application and move on it quickly. Another type of financing is, and I don't use this too frequently, it's usually used when somebody cannot get SBA financing or they don't have any retirement money, is hard money loans. And this type of financing is usually based on some type of real estate and equity in real estate that's utilized to help secure the financing for hard money loans. However, interest rates are typically daunting in hard money loans, and they can run anywhere from 14 to 25%. And they're usually used, again, in the last resort for people trying to use business purchase financing. Another type of financing that's sometimes used, particularly for smaller deals. Remember, I said in SBA financing, the lenders typically like deals that are priced over $100,000 or $150,000. There's many smaller businesses that sell for under $100,000, and there are specialty credit cards that can be utilized for this particular financing. These cards also come with a higher interest rate, but they're used to bridge financing, often for a down payment or again for a very small business purchase. The maximum amount of this particular financing tool is usually around $75,000, and it takes about 2 to 3 weeks to procure, and you usually need to have a minimum credit score of 675 or above. And you really can't have a lot of open credit card balances. They take a look at that and see what your overall debt load is. And if you typically have a lot of credit card debt, it's not going to work. So, in wrapping up, finding the right financing to buy a business all comes down to getting pre-qualified before you start the process of making offers on a business. That way you know what types and sizes of businesses you should be looking for and making it a seamless process by utilizing one or more of the financial tools we talked about on today's program. So, if you're interested in financing, you can find me on BizBen by using the keyword up in the upper right-hand corner of 28255. That's my profile number. Again, keyword me on BizBen 28255 to see my BizBen profile. You can also phone me direct at 866-270-6278, or you can see me also on bizbuyfinancing.com. I want to thank you for attending today's show on business purchase financing.
Thank you for joining today's featured show with your host, Peter Siegel, on the BizBen podcast. When buying or selling a California business, franchise, or business opportunity, make sure you receive professional advice on all legal and business matters pertaining to any transactions. The opinions and information expressed by today's guest are not necessarily endorsed by BizBen and Business Exchange Networking. Please join us again in the future to learn, share, and experience case studies, interviews, and focused information on the topic of selling and buying small to mid-sized California businesses.